Well, greetings and salutations, test takers. This is Dean Tinney. We're doing a ride along. Jasmine was rude enough to point out to me that we did not have, I'm teasing Jasmine, we didn't have completed the explication of the test specifications of Series 66. It's something that has always spoke to me because, it would be better to have it complete and have its own playlist. What had happened is I had thought, well, there's enough of this content elsewhere. So I didn't feel bad that, I hadn't finished it. But now those lectures that I felt were the, equivalent of this content are a separate playlist. You will now find all this in its own playlist. And this is plugging those holes that were left. We're plugging today, reconciling. Jasmine was kind enough to provide me with the things that need to be reconciled or holes that need to be plugged. We'll plug everything today in this video. That's a remainder except for laws and registrations. There's plenty of content there. And I told Jasmine that I probably will, her and I can do that, and then we'll have a complete another playlist. So that's kind of our game plan. Nobody expects you as an investment advisor representative to be a tax or legal professional. In fact, we should always say you should seek legal help. You should seek tax professionals, accountants. I do expect on the test that as an investment advisor representative, I have a general understanding of taxation and how it impacts investments, because taxes are one of the major impediments to investment success. And so we want to make sure that we have a general understanding. We don't want our client to go to his accountant and the guy say, hey, you need a new person. Your investment advisor rep is all messed up. Okay, so capital gains. When we turn our money into a security, that's called cost basis. And when we turn the security back into money, that's called sales proceeds. And that's either going to be a capital gain or loss. Now, if I've been at risk for more than 12 months, that's going to be a capital gain and taxed at a lower rate. So, I have a friend, Deborah, we both made an investment and we both got lucky. We made some money. And she had turned her money back into her investment back into money, sales proceeds. And she had a gain. And I said, I know how blessed you are, what tax bracket you're in. And I wish you would have checked with me. I'm not a tax professional. I'm not an accountant, but I'm going to hang out for another month. And she said, why are you going to do that? I said, well, if I hang out for another month, I'll be at risk for more than 12 months and I'll qualify for a long-term capital gain. And that would be a lower tax rate than ordinary income. Now, if I'm not at risk for more than 12 months, now I'm being kind of, I don't want to say I'm being obtuse, but I would give you a heads up that I'm not saying you have to hold an investment for more than 12 months. That is not the phraseology I used. I say you have to be at risk. I'm hinting that there could be situations in which perhaps you've interrupted a holding period on a security because you're no longer at risk. I don't think it's a big deal on the investment advisor representative 66, but there is a point to the particular phraseology I'm using. Now, when we net all our gains and losses from our portfolio, we can take up to $3,000 against my taxable income. We have this concept of adjusted gross income. So let's say Dean working for his money, I've got $90,000 in 1099 or W-2 from me working. And let's say I have $12,000 in losses. I can't take the 90 down to 78. I can only take the 90 down to 87. It's a recognition question. I think a lot of test prep vendors go overboard on the client, has this and, then they make on January, whatever. And, it's going to be a little more straightforward on the test. Now, qualified dividends. Qualified dividends. If you own a stock 60 to 90 days before the record date, again, I wouldn't worry about the 60 to 90 days. That's a qualified dividend, and that will be taxed at a lower rate than if you just buy the stock, 2 weeks from now and get a dividend. So qualified dividends are taxed at a lower rate. Otherwise, it would be taxed at your ordinary income tax rate. Tax basis. We talked about this. Your tax basis or cost basis, right? That's when you actually turn your money into the investment. I used to, as a practitioner, Jasmine, I'd say, listen, what I want to do is put your money to work for you. Because what I'd like, Jasmine, ideally, is to have enough money working for you that you don't need to work for your money. You know, listen, I'm blessed, and some days I come in here and in my studio, I go, "What the heck am I doing? I got enough money working for me that I don't need to do this." So I'm gonna have to come up with a happy medium of that. I have so many friends who are in California, and all they bitch do is bitch. And I say, guys, I'm tired of it. Every time I talk to you and come visit you, I just in California a couple weeks back. I say, why don't you do like Dean and move? And one of the things they're bitching about is their marginal tax brackets. I always joke, taxes are the price you pay for civilization. The more civilization you want, the higher the taxes you're going to have to pay. In California, the highest marginal tax rate is 13.3. Wow. Now, not everybody pays 13.3, and even the people who are paying 13.3 don't pay it on every dollar. So your marginal bracket is the highest bracket on the last dollar you earn, right? So if I tell you in California, Jasmine, and I tell you I'm in a 13% tax bracket, you might say, well, gee, Dean, you must be pretty blessed if you're in that tax bracket. You must be making a lot of money. I go, okay, well, that's kind of rude, Jasmine, to suggest that, but yeah. And Jasmine says, well, Dean, you're not paying 13.3 on every dollar you make. It's only on those last dollars over, I forget what it is, California, over, a million or whatever. I never made it that high. One time I was talking to my accountant, and I go, man, that's all I owe. I said, that's wonderful. And he said, well, Dean, that's not good. That just means you didn't make as much money as you usually do. I go, well, why are you raining on my parade? Um, Alternative minimum tax, test question. Again, don't get in the weeds on this. Don't get in the weeds on this. This is a simple suitability question. As an investment advisor rep, I say, Jasmine, are you subject to the alternative minimum tax? It's a simple yes or a simple no. The person who's subject to this will know it. So if I'm an accountant, I call you and hey, you got some good news and bad news. The good news is I calculated your taxes and you don't owe any money based on that calculation. That's the good news. The bad news is now I got to recalculate using the alternative minimum tax. Everybody is going to owe something. Now, the reason that's important to me as an investment advisor rep is because I wouldn't want to recommend a private activity bond to you. A private activity bond is what the IRS calls an industrial development agency bond or an industrial development revenue bond, IDR. So it's a simple suitability question. Now, a lot of people get hung up on pension or retirement distributions. There's no way to turn a distribution from any kind of pension or retirement plan into anything other than ordinary income. So it doesn't matter how long that's been in there, it doesn't matter. Oh, what happened? My annotation tool turned off. Boom. All distributions from any kind of a retirement plan, qualified, not qualified, it does not matter. All distributions are going to be taxed at ordinary income. Now, you might have a cost base. You want to have a cost base in a most qualified retirement plans, but you might have a cost base in like a variable annuity. Boom. IRMA has been showing up on the test of late. What happens is, sometimes people say, well, Dean, how do you know something's not on the test? I said, well, Jasmine, they just can't randomly make up things to test you on. It has to be within the test specifications. If it's in the test specifications, it's fair game. And, there's a lot of things in the test specifications, like IRMA, that's been here since June 12th of 2023, as you can see on the test specifications, that nobody ever has been tested on until recently. And then we start getting some reports on debrief. I'm not allowed to ask test takers, like, what was question 13? What I can say is, hey, what didn't I go over in your, tutoring session you think I should have? And you said, well, Dean, you never mentioned IRMA. I said, well, I didn't mention it because I never heard anybody get it. And now they are starting to do it. Now, when the new questions come up, We're recording this in May of 2025. They're testing them for validity first before they count. So usually when these new kind of questions show up. Now, what the question about IRMA is about is the income retirement adjustment for Social Security. It's a surcharge. And what people get asked about is this adjustment, the surcharge. Recommending, again, the test, I think that you get it right with the acronym. Income related monthly adjustment. That's what they're going to adjust your benefits. There's going to be a surcharge if you make a certain level of money. They don't get into that. But the surcharge applies to Medicare, and that's the second best question people get is what part of Medicare does this surcharge apply to? And it's Medicare Part B and D. So, it's there. All right, so income tax fundamentals. So C Corps have retained earnings. And when you think about it, don't think too hard because it'll make you mad, depending on what you feel about taxes. But when you think about it, I buy Apple stock, and I buy my Apple stock with money I've already paid taxes on in my personal account, we'll assume. And then Apple makes money, pays taxes, and then pays me a dividend, and I pay taxes. Wow, so that money is getting, taxed more than once. So C Corps as a business structure are going to be taxed on their earnings, right? And then the dividends come from the earnings if the board decides to distribute that, and those dividends are taxed to me. So dividends are taxed at ordinary income unless we said they're qualified dividends, or unless it's a dividend of one corporation paid to another, which is 50% tax excludable. And that's why corporations, this happens a lot, that corporations, are the best vehicle for, raising large amounts of capital and, selling stocks and bonds and all kinds of things. But I kind of joke, I have a LLC. And good news for Dean, there's only one member of the LLC, and it's me. It's called Guru Exam Prep LLC, and I'm the managing member. And, I can't tell you how many people I know who have LLCs, and they will make their significant other a 30% owner. I have a friend who made his mom a 30% owner. And, now they decide they want to retain earnings and build the business. And whether it's mom or significant other says, well, no, I like my distributions. I like my flow through. So C Corps, the point is the only vehicle that does not have a flow through. Other business structures have a flow through. S Corp, for example. And S Corp has a flow through of the tax consequences. I always tell the story of the first broker dealer I worked for was a subchapter S corporation. And it was owned by Mr. K. And I said to his son, Jeffrey, I said, hey, Jeffrey, we could make money if we tried. And he said, well, Dean, we're not trying. This is a subchapter S. This is a tax shelter for my dad. I go, really? I go down the hall to his dad. I said, Mr. K, are we trying to make money? He goes, Dean, I'm disappointed you'd have to ask such a silly question. Of course, we're trying to make money. But in the early years, if we lose money as an S Corp, it flows through to my personal tax return. And when we make money, which I hope is lots and very soon, it flows through my tax return and gets taxed once. Now, I always joke, Jasmine, if the IRS wants to talk to somebody about our business entity, should I send them to Jeffrey's office? This subchapter S is a tax shelter for daddy. Or do I send them to Mr. K's office? The tax benefits are important, but I'm not letting the tax tail wag the investment dog. That's the right answer, right? So our business structure should always be about hoping to make a lot of money and pay taxes someday. Keyword someday, maybe not right away, but someday, right? So we have C versus S, and that's the testable distinction. Is that flow through? Remember, your subchapter S can only have 100 shareholders, and it can have no non-resident aliens as shareholders. That too is testable. Well, we have REITs. I don't know if it's helpful. I think of REITs as kind of like a mutual fund. It has the same benefits: professional management, diversification, ease of ownership, but it's a professionally managed portfolio of real estate investments, right? And how do we make money in real estate? We originate perhaps mortgages and collect interest in principal. We buy properties low, we sell them high. And so that's what a REIT is. And like a mutual fund, a REIT's going to pass through 90% of its net investment income. We have master limited partnerships, we have LLCs, and again, those have a flow through of the tax consequences. Wealth transfer tax, very testable. It's not, don't get into the unified credit or lifetime or portability. It's mainly, do you understand the difference between a step up in the basis when somebody dies? So, the one they love is a grandmother who dies, and her granddaughter inherits the securities. And when she bought the securities, her cost basis was 50. When she dies, the market value is 120. Cost base to granddaughter is 120. Now be careful on this because it's almost the exact same question. And if you're not reading carefully, you say, oh, I got the grandma granddaughter question twice. And the second version looks very much like the same, except now grandma is not dead. She's alive and she gifts the securities to her daughter. And when she gifts the securities to her daughter, that's an entirely different thing, right? They're going to assume their cost basis. So that's the key about wealth transfer. Retirement plans, we have traditional and Roth. What you should be able to do is contrast some of the major testable points about a traditional IRA versus a Roth. The Roth is being funded after tax. The traditional depends on how much you'll be able to deduct based on your income and access to a qualified plan. We don't really get into that. And for the most part, they're very similar in that you have to have earned income to fund them. They're very similar in this idea of 59.5, 10% penalties, that kind of thing. But where the Roth is major distinction on the Roth is there is no RMD and the distributions are tax-free. So you should be able to contrast the traditional IRA with those Roth on those key kind of points. Now, if I'm a closely held business, so, I'm very, very, very busy. As I told you, I'm at the point where I got to decide to dial it up or dial it down. If I dial it up, I have a workstation that's empty next to me. And if I dial it up, I'm going to, have somebody sitting there next to me and they can handle all the stuff that, I don't want to do. And maybe we can keep at the level I'm doing. But let's say I do hire somebody. As a closely held business, I set up a solo 401k. So test question number one is solo 401k is for a closely held business, a small business. You can think of it that way. And then the second test question is that if I do have an employee, I have to do at least for that employee what I'm doing for myself. So is a solo 401k, if I'm putting X number of dollars and matching myself, I got to take care of that. Now, when you go to work at an corporation or for employer, any employer, for example, it would be important for you to ask HR, what are some of my benefits? And a huge benefit would be, what are my retirement benefits? And I say, hey, do you guys have one of those old-fashioned defined benefit plans? Not many employers offer these anymore. In a defined benefit plan, the employer is assuming the investment risk. This is where we say, after working X number of years, you will get a percentage of your base pay in health care for the rest of your life. Wow. Not many employers offer that anymore because it can end up in a situation in which we have an unfunded pension liability. And, we don't want to have unfunded pension liabilities. So most employers today offer what are called defined contribution plans, where we say, Jasmine, we're not going to tell you what you're going to get in retirement because our crystal ball is kind of broke. But we will tell you what your employer, will contribute for your retirement. The one that most people are familiar with is a 401k. There's others, but that's the most one that people are most familiar with. And I say, Jasmine, we have a 401k plan, and we're going to, as your employer, match you dollar for dollar on the first 3%. That's our contribution for your retirement. You invest it, whatever it grows to or falls to, that's what you get. And so in a defined contribution plan, the investment risk is assumed by the employee.
It's kind of, I was telling you, we have a company visiting, and I'm kind of a weirdo, I'll admit. I like, I'm nosy by nature, and I, we have this property, and it's my sister-in-law's dad. What would that make him to me? Anything? Well, this guy's name is Mike. And my sister-in-law was awake very early and he's visiting. And I said, listen, I'm a morning person. So if you want to come out to the property early, just give me a call and I'll come get you and bring you out here. And he was saying that he likes having all this land because he's in Santa Monica, another Californian, right? And he says, Dean, I can't even find any dirt to run my little cars. He likes to race these little cars around, the fake cars. Yeah, to each their own. And he was talking about putting a trailer, kind of hinting it would be okay with me if he, puts a trailer on the property and comes and visits more often. I said, hey, Mike, you can do what you want. I said, but, and again, I'm a nosy guy. I always said, you have the resources to, you know, because I know you're, 80 years old. And so he started telling me about his wife's 401k, Jasmine, and his 401k. And I thought, oh, well, I wasn't looking for that much information. But he was basically saying that in their defined contributions plans, they both still have some monies to be distributed. And, I felt like saying, oh, did you get your mandatory RMD letter yet? Whatever the case may be. Now, the next test question here, very testable, is 403Bs. And the test question is who qualifies for a tax sheltered annuity? Tax sheltered, not tax deferred, tax sheltered. Who can fund a annuity with pre-tax dollars? And again, the titles sometimes are helpful. 403B is an educational institution. So if you're an employee, key point, employee. That just doesn't mean teachers. That could be the janitor, it could be the nurse, not the students. They qualify to fund a 403B. And then the follow-up is also employees of 501Cs. Charitable organizations. Think here like a nonprofit hospital, the Sisters of Mercy or something. These Catholic nuns own a hospital, and there's doctors. Well, I shouldn't say the nuns own it, the nonprofit does, but the doctors, the nurses, the janitors, again, not the patients. So a couple test questions follow from. It's kind of like the dead grandma question. Got to be real careful. There could be a question that looks exactly alike, except three letters, non-qualified. So one version of this is somebody who's putting $50,000 into a non-qualified variable annuity. And that $50,000 represents their cost basis. Boy, and you got to read real carefully because the next version of this question is almost the exact same wording, except now they say it's a qualified variable annuity. And now we got to say, oh, everything coming out is taxable, right? So be careful. 457 is a type of deferred comp. And here you should be thinking again about who qualifies for this. And I always think here like policemen, firemen, a lot of my cousins are police officers and they have some of them a very simple lifestyle. They can't spend all the money that they make anyways because they're in their police car and at the donut shop. I'm teasing, they're, not the donut shop. And they have deferred comp available to them. Now, the big non-qualified plan that you should be aware of is, again, the variable annuity. So if I have maxed out all of my other plans that are available to me, I wouldn't worry about simple IRAs or SEP simplified employee pension plans. But if I've maxed out everything else, I can fund a variable annuity. And this is going to be more taxed based on the investment vehicles section of your test than it is in your retirement plan section of your test. Now, ERISA stands for Every Ridiculous Idea Since Adam. No, I'm joking. It stands for the Employee Retirement Income Security Act. And we had two major problems in the pension plan arena that caused us to pass Congress in 74. The Teamsters kept lending their pension money to the mob, and Studebaker had a retirement plan that went under, and the Studebaker retirees never got their retirement. And so as a result of those two, we passed ERISA. And ERISA says the Employee Retirement Income Security Act, as it is a fiduciary. In other words, these pension plans, these employee retirement plans, it covers private pension plans, doesn't cover public pension plans. Doesn't counties and cities and states and school districts, no. Covers private pension plans. that they have a responsibility. Now, they aren't required to have an investment policy statement under ERISA, but it helps in terms of their liability as a fiduciary. And so this is where we spell out, some firms actually do this for non-qualified plans. They just do it for even for customers. It doesn't say what we're going to invest. It just got to speak about, what who would consider to be have adverse interest with the pension plan. Even after we passed ERISA, I can't tell you how many times, Jasmine, I still see people get in trouble for this. Here just very recently, the new guy at the UAW is fine. I mean, he's a fire and brimstone guy who's in charge of the UAW. But they just let go the guys before him because they were getting Rolexes and cigars and scotches from people who were wanting to do investments for the pension plan of the UAW. And you would think, geez, somebody in the room would say, you know what, I'll just take care of my own cigars, my own scotch as a fiduciary. I don't want people to think I'm being compromised, so give them a Rolex, whatever the case may be. I told you I've got a demented Jasmine. I know a guy who is retired from Chrysler as a defined benefit plan. And I was teasing him. I said, man, I can't find anybody who likes this CEO. The Chrysler dealers don't like him. The shareholders don't like him. And from I understand, employees presently and retirees, you don't like him. I said, man, this guy, I don't know how he's going to continue to be running Chrysler if he has no constituents that even believe in him. And then I asked him, I said, are you worried about your pension plan? And he said, well, Dean, actually, I'm not worried about my pension plan because it doesn't come from Chrysler, it's the UAW. And so I guess, they have I didn't know this, they have a multi-employer, what's called a pension plan where, all the Ford, GM, and Chrysler workers are pooled into the UAD pension plan. But he told me the health care does come from Chrysler. And so his healthcare part piece of that, he said, yeah, I don't know how wobbly it's getting. I don't either. But at least we have. I told him that there's a pension benefit guarantee corporation that should take care of that. Now we have a thing called behavioral finance. Oh, by the way, one more thing. We're talking about shielding liability and as a fiduciary. And if we're using a defined contribution plan, it would be important to give the employees at least three choices in terms of that 401k, at least three mutual funds is what I would think of this as, right? I can't just make you buy the ESOP and buy the employer stock, right? So three choices, an investment policy statement helps us as fiduciaries shield ourselves from some liability, saying, hey, I offered the employees three. And, one more point, I'm getting a little carried away. There's only two questions on this. But I had an insurance company. I was training all their reps to pass their NAS exams. I mean, hundreds of these people. And sometimes this is like a contagion, Jasmine. Somebody says something, the next thing you know, everybody is getting wobbly on ERISA. I'm like, guys, if you guess B on all the ERISA questions, you're still in the game. I don't know why everybody's getting worked up about ERISA. Um, but one other thing I'll just add here is another way to shield yourself from liability is you immediately vest your employees. You don't have to worry about top heavy testing. So, if I say I had a guy who came to work for me, his name is Patrick, and we had a hellacious pension plan. I mean, oh, it was awesome. I said, listen, we put 25% of the profits into this plan, Patrick. We match you dollar for dollar pre-tax on the first six. You can pick one of these mutual funds. You're vested over a 5-year schedule. And so when he tried to resign in 4 years, 11 months, I said, no. I said, Patrick, you need to hang out another month so you can get all that money, be fully vested. If we're immediately vesting the employees, we say, listen, we're going to match you dollar for dollar in the first three, and you're immediately vested that too, if we have an immediate vesting schedule. Now, you're always going to be able to get your own money, the money you put in there. So that's one more thing that would shield us as fiduciaries under ERISA. All right, we're invest special types of accounts. Yeah, and this one, the test question here is in the beauty contest between a Coverdale and a 529. We should definitely know the Coverdale is the clear winner. Or excuse me, the 529 is the clear winner. Why? Because 529s don't show up in the kid's application for financial aid. 529s, you can front load 5 years without running afoul of the gift tax. I don't know, Jasmine, you're a much younger lady than I am as an old man, But even when I was going to college, man, $2,000. I mean, what does that buy? I mean, what, a couple books and maybe 3 credits or something? So 529s is just contrasting that that's a much more competitive way. In fact, I know a lot of financial institutions don't even offer Coverdales and actually have frozen the Coverdales that are already around because they're just no sense. And when the 529 is that much more competitive. Uniform Transfer to Minors Act, Uniform Gift to Minors Act. I really think here is an area where a lot of test prep vendors really go overkill in terms of comparing and contrasting UCMAs and UMAs. That's really not where the test questions are. The test questions are to know that you can only have one minor, one custodian per account. You can have multiple donors, but only one custodian, one minor per account. To know the kid's tax ID number goes on that account, and to know no margin, right? And then I would know that UGMAs, I don't know if any states can even use UGMA again. It's kind of like a Coverdale situation. But Uniform Gift to Minors Act, it's re-registered at age of majority, 18 or 21. And the UTMA, Uniform Transfer to Minors Act, you can stipulate up to the age 25. And the assumption is the minor's going to have better judgment at 25 than they are, 18 or 21. Ownership and estate planning techniques. This is very testable types of ownership. I kind of joke, lots of questions about dead people on the test. I'm not quite sold on AI yet, but I was tutoring somebody and I said, I'm thinking of making a video about dead people, all the dead people questions, but I can't think how I would tactfully title that or what I would do. And he had Chat GPT and he said, Dean, well, let's put it into the Chat GPT for some ideas. I thought, oh, let's do it. And it came back with suggested titles of this non-existent lecture I haven't done yet, Jasmine, called The Afterlife of Money. I thought, oh, that's a good title. I would have never thought of that. Another one was Ghost Accounts. I thought, oh, right. So another dead person question is what happens with joint rights or survivorship? This should be layups on your exam. This should be layups, right? So decedent share goes to the surviving party. Tenants in common, decedent share goes to the estate or beneficiary. Tenants by entirety is for real estate between spouses. It prevents one spouse from transferring the asset without the other spouse being aware of it. Community property. Community property is just based on how long you've been a domestic partner and at what point property becomes community property. Haven't had anybody on that testing tell me they've seen that. TOD, very testable. They have a question about a aunt with a nephew. And they tell you that the aunt is worried about the nephew's creditors getting access to this money. And so she makes a transfer on death, and the test question there is avoid probate, right? And so that's very testable. Uh, per stirpes versus per capita is just different ways states distribute money when somebody dies. It would be better that instead of relying upon the state to do it, that you put it in your will, how you want assets distributed, or even better, create a trust. Qualified domestic relations orders are very testable. I don't know of any draw in which you're not going to get asked about a quadra. I always think of my friend. She divorced a very high level Salesforce exec, and so she's entitled to a distribution of his assets that are in his qualified retirement plan. Rightfully so. So this is a judge telling the custodian to distribute to her share of those assets that have been determined in this divorce proceeding. That's the test question. It's qualified domestic relations order. So it applies to a qualified plan where there's a custodian who's receiving a court order, not, their joint account and she's taking half that way. No, we're talking about domestic order. Now, the other test question is, in my example, she now has 60 days to get that put back into a proper place, roll it over into a Fidelity IRA or something, or whatever she wants to do with it. Otherwise, it's going to be a taxable distribution to her. Now, I know people are surprised to know that I don't have my own foundation. I don't have a Serious Guru foundation where I do my philanthropy. One of my things I like, Jasmine, is saving tigers. We're losing tigers in the world, and there's very few habitats left. And I could donate appreciated securities to the Save the Tiger Fund, a 501c. And if I make that donation to the 501c, by the way, it makes sense for me not to sell the ExxonMobil stock, and pay the taxes and then give the money to the Save the Tiger 501c because the tigers end up with less money. So it'd make more sense for me to donate those appreciated securities, either sign it over to the 501c. An easier way to do this is set up my version of the Gates Foundation or my version of, whoever, the Ford Foundation, is do a donor advised funds. Like, so one of the largest charities in the country is the Fidelity Gift Fund. It's a 501c, same thing here. Now what I'm going to do is instead of donating my appreciated securities to the Save the Tiger Fund, I'm going to donate the appreciated securities to the Fidelity Gift Fund, a donor advised fund. They're going to sell those securities. Good news, no capital gains taxes because they're a charity. And then I'm going to direct the donor advised fund, in this case, the Fidelity Gift Fund, to send X number of dollars to the Save the Tiger Fund. So it's a more simpler. By the way, these whether Schwab has a version of this, Fidelity has a version of this, Vanguard has a version of this. These are some of the largest charities in the country. I was reading where even Bezos, McKinsey, his wife, when she took a distribution quadruple of I don't know how much Amazon stock she got. It was billions of dollars worth of Amazon stock. And I read where she put it in a donor advised fund. She didn't set up her own family office or, what do I know? I only know what I read. It was probably a family office still, but I mean, she didn't set up a McKinsey fund. She just set up her own, put it into a donor advised fund, and then she just calls the funds and tells them to send, what was it? Here recently, about 2 years back, people started getting anonymous donations of like 10, 20 million. And I kind of respect this. She didn't tell anybody it was her, but they figured out, well, who is this person who's sending out, checks to people for and it was McKinsey. I don't know if she still calls herself Bezos or not, but a good way to do it. Good way to do it. All right, so we're almost done here. Portfolio performance measures. This is very testable. So risk-adjusted return. When we talk about risk-adjusted return, I always use the example, Jasmine, of my brother from another mother, the Test Geek. We do some collaborations, Test Geek and Guru, and I joke that Jasmine, you give Brian $1 million, you give me $1 million, and you say, gentlemen, I'm having a beauty contest. And as you know, I have millions more behind this, and here's how this contest is going to work. Whoever has the most money at the end of the year is going to get my entire portfolio. And so Brian, at the end of the year, is foolish enough to tell me his return. And come to find out, we both have the same return. And he says, gee, this is going to be interesting how Jasmine is going to break the tie. And so we both show up and you say, well, I don't know what to tell you, gentlemen. It's a tie. I go, Jasmine, it's not a tie. I'm the winner. And you say, well, Dean, what makes you think you're the winner? I say, I have a higher Sharpe ratio. I have a higher Sharpe ratio. God knows we're not going to make you calculate the Sharpe ratio. But what I'm saying to you, by the way, it's named after Professor Sharpe. Anything that has a name like this, is I'm saying, listen, it's not a tie, Jasmine, because while we had the same return, I had a higher risk-adjusted return. I got the same return with less risk, and that makes me the winner. Now, if I wanted to jazz it up, I don't know how highfalutin I want to be with you. But the other way I could say this is my portfolio is more efficient. More efficient. There's unfortunately a lot of people who are willy-nilly. Even though we tell them mutual funds are for the long term, mutual funds are for the long term, they still are willy-nilly and they take money in and out all the time of the fund. And we don't think that the managers should be accountable for the inflows and outflows of that portfolio. So, dollar weighted returns would be more fair for a mutual fund because it takes out this idea of money washing in and out of that fund. And time weighted return would be more appropriate for like a separate account of a doctor, his portfolio, right? Because the money coming in out of that portfolio is directly to that particular account, right? So time weighted versus dollar weighted. Not going to make you actually do any math here. Just going to ask you, basic understandings of these performance measures. Your annualized return is certainly there. Pretty straightforward. I say, hey, Jasmine, if you look at this buy right that I'm suggesting, this covered call, if this works out, we would make a 9% return over the next 3 months. He said, well, 9%. I go, well, yeah, maybe that's not exciting, but if we times that by 4, if we could find a covered call like this every quarter, we would be making 36%. An annualized return is the more fairest way to talk about returns, right? So, I mean, what I mean by the fairest way is, so you tell me you made 50%, and I go, wow. And then you tell me it was over 50 years, not so impressive, right? So most of the time, this would be what we'd be most often be referring to as an annual return. Total return, very testable. The only two ways you can make money in an investment is the income stream and or the price appreciation. The income stream and or the price appreciation. So if I tell you, for example, a stock has a 25-cent quarterly dividend, that means you're making $1 in income from that stock. The income could be rent in a real estate, the income could be interest in a bond, whatever that income stream is. And then the other way we can make money is from price appreciation. Those two things together are called total return. And this is something you might actually have to calculate, right? So, usually I tell people, they don't have to calculate things, but, you might. So let's say this is a $10 stock as your cost basis. Remember, that's when you turned your money into this investment. And then I tell you that you turn this back into money at $11. That's your sales proceeds. And I tell you it was a year. So I say, okay, well, 4 times this is $1. I made $1 in annual income, right? And then I made another $1 in sales proceeds. So I made $2. And I spent, to make that $2, I spent 10. So test question, my total return is 20%. So you might actually have to do that. Holding period return means we're not taking into account how long you held the investment. I don't know if it's helpful, but I think of the internal rate of return as the bridge between present value and future value. Between present value and future value. I spent most of my career without running into any kind of complaints or any kind of regulatory pushback. But my guy at FINRA, Jasmine, was a guy named Lenny. Hey, Lenny, if you're listening, I'm joking. I should do that. I'm teasing. Nice guy. If she's out there, Lenny, nice guy. But Lenny took exception, Jasmine, to an email that was captured. And I'll give you my pushback. It was to an institutional investor who, Jasmine, is capable of protecting their own assets. And I was telling them that they made an asset allocation of $10 million to this private equity fund, present value, 10 million. And this private equity fund, which was targeting an internal rate of return of 12%, 20%. They made it very clear that's a target. There's no, even though, like I said, guaranteed. I didn't even say that word. I said, here's what the future value of the $1 million would be based on an internal rate of return of 20%. And Lenny at FINRA took an exception to me using the numbers in that. But right, I have a future value. I have a number of compounding periods. The expected life of the private equity fund is 7 years, right? So I have everything I need to kind of calculate that. Now, whether or not I'm going to do that. Now, where this shows up is in this idea of a bond. A lot of times they'll say, what reflects a bond's internal rate of return? And that would be the yield to maturity, right? So I said the bond has a basis of 8.5%. or yield to maturity, which is the fancy word for yield to maturity basis. I'm saying the internal rate of return is what takes that price of the bond you paid, present value, to the future value, which is, redemption, maturity. So, for what it's worth. Now, expected return is based on how much risk you're willing to take, right? And this is based on beta. Beta is a measurement of volatility, right? And so I say our expected return, Jasmine, if we have a 10% market return, market is always the S&P, and we have a beta of 1.5, our expected return would be 15%, right? And remember, the excess would be either excess or below, but if we got 18, that would be alpha. Alpha means we got higher than our expected return, right? Yeah, I won't complicate it. Face of death draw, they might get into, calculating, or not calculating, but understanding risk-free, that we could have got some of that 15% without risking our capital. They might refer this kind of as a more complicated thing as CAPM, about expected returns, using the capital asset pricing model, but I wouldn't worry too much about it. Inflation adjusted returns definitely there. This is straightforward. People make this more complicated than it is. You have a 10% return, and inflation, I think we hit as high as 8% here recently, right? Over 8%. Woo. And so then I would tell you that you didn't really make 10%. You really only made 2%, right? We just simply subtract the CPI rate, the inflation rate, from the return, and you get the inflation adjusted return. I think the best example of this I can recall was an All in the Family episode where Archie came home from the factory and he told his college educated son-in-law that he got a 5% pay raise. And he said, Archie, you didn't get a 5% pay raise. He goes, what do you mean I didn't get a pay raise? I can show it to you right here. He said, Arch, CPI went up 10. What he was trying to tell him is that he actually took a 5% pay cut, right? Because of that adjustment. So you simply net that. After tax, again, very testable. And let's say I have an 8% bond, and we should be able to turn that into $80 annual interest pretty quickly. And I say you're in a 30% tax bracket. And we say, okay, well, if you're in a 30% tax bracket, I'll put that in red. I'll put it in red to reflect that that's coming out of your return, right? Because that's what the government wants from you. So I'll take my $80 times 30%. I'm going to have $24 I have to send to the government, right? So now I just take my $80 and I'll put that in green. I minus the $24 in taxes. I'll put that in red. And then you on the test would tell me, now, listen, I'm not being facetious here. So, I'm not being facetious. If somebody offers me a calculator, I'm going to say, thank you very much. And so 80 minus 24 is 56. So my after-tax return here is $56. Now, remember, in bond speak, that would be 5.6. So that's what we're left with after tax. So, when people get hung up on the math on 66, what they do, Jasmine, and I just think it just makes them go wobbly. And I get all kinds of math geeks and accountants, and they think, oh man, I'm going to get so many points because I'm an accountant. I'm a math guy. I go, not really. Everybody kind of starts with zero. But the math here, these performance measures are actually more testable. Total return, you got to do current yield after tax. That is the math that is more likely to be tested than anything to do with discounted cash flow or present value or future value or any of that kind of stuff. So, and almost always, is if you've been with me for a while, I always say, if you can't decide what to do, divide. And I can't imagine a draw on the test in which you don't get asked to calculate current yield. Current yield is what an investment pays you divided by what it costs you. A good way to remember this is AMP. AMP. And AMP stands for annual interest or dividend divided by the market price. So previously, I told you a stock had a 25-cent quarterly dividend. And we said that means that would pay us $1. There's our annual dividend in this case. We divide by the price, what it costs us. And very testable, you would tell me that has a current yield of 10%. Right? So performance measures definitely there. Relevant benchmarks. We talked about these the other day, I think, in a previous, and that's how the exam itself in the test specifications kind of go. They're all over the place. Another section of this document, we talked about the Russell 2000, the S&P 500, the Dow Jones Industrial Average. What was another one we talked about? Was 5,000 S&P. So, when we talked about that, those would be benchmarks, particularly as it relates to performance-based compensation. And the test issue is not so much about the appropriate benchmark, even though that's there. The test question is that if I am receiving performance-based compensation, to you as a client, it presents you with more risk. Because the idea is I would be willing to take more risk to be entitled to my performance-based compensation that I always would not. I say what you want. Everybody's different firms, but boy, I'll tell you, Ken Fisher, Fisher Investments is so self-righteous. I mean, he is just, to a level that kind of makes me just want to shut off the TV when I, see him think. Now, I'm just thinking in his mindset. That if I told a client, let's say we're both competing for business, and I say, Jasmine, I want performance-based compensation. Here is my benchmark. And, Jasmine, this gives me incentive to take additional risk because, I like my performance-based compensation. I can already say here, Ken Fisher, telling Jasmine, that's a conflict of interest. We don't do that at Fisher Investments. We just take a flat fee. So we have no incentive to take additional risk. I'm like, okay, right, whatever. Ken, if you're watching, I apologize. I'm just, think that nothing untruthful there. I do think you hold yourself out as having a higher fiduciary standard than perhaps the rest of us, which I'm not so sure. All right, well, that concludes, I think, plugging the holes we left in the test specifications on Series 66. We'll put this in the 66 playlist. And I think my friend Jasmine has convinced that we will go through at some point, that's the last part here, even though there are all kinds of videos, hours of videos on all these things in that what is now the third playlist. We will still finish this at some point, hopefully before Jasmine's test, because she's been the volunteer to do this with us. Remember, inch by inch, your 66 is a cinch. Yard by yard, your 66 is hard. And we'll see you for the next explication segment.